Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, April 21st, 2023, and joining Lee to pose some questions on the financial market themes for the week ahead is Andrea Hayward, Vice President of the Japanese Client Sales Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Andrea.
Good to be able to catch up with you again. We've had quite a wide range of economic data over the past week. We've had US retail sales in March showing a 1% fall for the month-on-month at the end of last week. But then this week, New York State manufacturing was positive for the first time in 5 months. We've also had a decrease in the UK headline inflation rate, slightly above expectations at 10.1%, but down from 10.4%, but with food inflation running above 19%. There's also been a change in expectations of where interest rates will be by the end of this year. So what exactly has been driving force in the FX markets this week?
Yeah, good question, Andrea. I'd say certainly one of the main developments over the past week is that we have seen the dollar stage a rebound against most G10 currencies. Admittedly, it's only a fairly modest rebound. And to us, this has mainly been supported by some of the expectations for Fed rate cuts have been taken out of the curve for later this year. So earlier this month, the market had moved to price in about 325 basis point rate cuts. And that's now been scaled back to only around 25 basis points of cuts by the end of this year. So the market is kind of becoming less bearish over the outlook for the Fed policy going forward, and has also moved to fully price in again another 25 basis point hike at the next Fed meeting, which to us looks like a more reasonable scenario at this stage. Certainly if you look at the comments from recent Fed officials, particularly from New York Fed President Williams, he certainly seems to agree with our view that we're likely to get one final 25 basis point hike, and then that's likely to be the end of this hiking cycle as the Fed moves to pause their hiking cycle. And to us, that certainly makes sense from a fundamental point as well. If you look at the latest data flow again that we've had over the past week from the US, we have seen further signs of economic weakness coming through, signaling an increased risk of a sharper slowdown in US growth going forward. While at the same time, if we look at the latest inflation data from the US, there's certainly more evidence there as well that the disinflationary pressures are building in the US. So to us, it makes sense to get one final hike from the Fed, and then they can take a breather to assess what happens going forward with the US economy. That does, though, kind of there's certainly somewhat of a contrast, though, between what's happening in the US to what's happening outside of the US, where more recently here in Europe, we've seen again data from Europe has surprised to the upside, both in terms of some of the activity data and also the inflation data. Like you were saying, Andrea, in the UK, this week we've had some particularly lively wage data from the UK, and also the latest inflation data was stronger than expected, which is certainly reinforcing expectations that while the Fed might be getting closer to pausing their hiking cycle, the Bank of England looks like they're going to have to keep hiking rates for a bit longer than the Fed. The market's now moved to fully price in a 25 basis point hike from the Bank of England at their next meeting in May. And the expectation there for the peak rate in the cycle has moved up closer to 5%. And a similar kind of story has also kind of been playing out in Europe as well, where we've seen ECB officials over the past week have also kind of left the door open for another larger 50 basis point hike at their next meeting in May. So they're certainly sounding a lot more hawkish than the Fed at this stage. And that's also backed up as well by the inflation data as well from Europe this week, where we saw fresh fresh cyclical highs for food and core inflation in Europe. So there's certainly pressure still on the ECB to do more in terms of hiking from here. So I think when we put that all together, it does point towards the Fed looking like it's going to be the first of the major central banks to pause their hiking cycle, while the Bank of England and the ECB should keep hiking rates for longer. So from a kind of rate spread perspective, that does point to some further downside potential for the dollar from here.
Okay, so we'll watch what happens with the central banks coming up in May. On another theme, there's been a lot of conjecture surrounding the new Bank of Japan Governors Ueda's first policy meeting, which happens at the end of this month. What is your outlook as to what part a potential change in their monetary policy will play, if any, and what would be the implications for the yen going forward?
Yeah, certainly next week, one of the key events will be the BoJ meeting on Friday. Like you say, that's going to be the first policy meeting under new Governor Ueda. And certainly expectations or excitement ahead of that meeting has been dampened recently. We have had kind of quite a clear pushback from Governor Ueda and also other kind of media reports, which have downplayed the likelihood of the BoJ adjusting their policy settings as soon as next week's policy meeting. So, yeah, I think unless there's a big surprise, we're expecting the BoJ to leave policy settings unchanged next week. I think for the market, it's kind of already kind of reacted to that kind of expectation. If we look at dollar yen's performance in recent weeks, we have seen it bounce back up towards the 135 level from a recent low of just below 130. Obviously, part of that's due to the recent pickup again we've seen in US yields, but we also think another kind of contributor to that recent yen underperformance is also the kind of paring back of expectations that the BoJ is going to change yield curve control settings in the near term. So not expecting any major surprises there from the BoJ next week. We will, though, be watching closely to see if there's any kind of signals from the BoJ over a potential shift in yield curve control settings at following meetings. Speaking to our analysts in Tokyo, they're still looking for the BoJ to abandon their yield curve control policy settings this year, although they have pushed back the timing of when they think that's going to happen from the June meeting to the July meeting. And one of the reasons why they think they might wait until July before they change yield curve control settings is that they think political developments in Japan could delay that process of policy adjustment. At the weekend coming up, we do have 5 by-elections taking place. And that's going to be watched closely by market participants to see if that increases the likelihood that Prime Minister Kishida could call early snap elections. Our analysts in Tokyo, it's their kind of baseline view that Prime Minister Kishida will look to strengthen his grip on power within the LDP and will take the opportunity of calling early elections potentially in June or July. And that if that does materialize, then we do think it would be more difficult for the BoJ to adjust policy settings close to an election in Japan. So that could certainly push back the timing of a further shift in yield curve control settings. So short-term wise, obviously, if yield curve control adjustments were pushed further into the future, that's another reason why we might see speculators will be more reluctant to come back and buy the yen in the short term. Although we do think ultimately if Prime Minister Kishida is able to win and strengthen his grip on power in a snap election, that could actually then open the door for bigger shifts in policy settings in Japan, which could include obviously the BoJ moving away from the loose policy settings that have been associated with Abenomics. So ultimately that could end up to being more of a yen positive further down the line. But short term, we don't think the BoJ is going to be making any significant changes which would trigger some further yen strength in the short term. But we also have to take into consideration as well, obviously, what's happening in the broader markets. And we are certainly more convinced now that US yields have peaked out and that we expect US yields to fall as we see more evidence of growth and inflation in the US slowing down. And to us, that makes us more confident that ultimately dollar yen will resume its decline. And we do still look for that to break below the 130 level later this year.
Okay, that's great. Thank you very much for your insight, Lee.
Great. Thanks, Andrea.
Have a great weekend.
You too.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.